Well, thank you. Thank you to everyone for being here. Thank you and welcome to the 2015 Business Leaders Forum. My name is Dave Clark. I'm the Executive Associate Dean of the College of Business Administration, and we have an excellent program for you today. Shortly, we'll hear from Dr. Charles Evans. He's the President and CEO of the Federal Reserve Bank of Chicago, in what promises to be a fascinating and insightful presentation on monetary policy by one of the nation's leading monetary experts. But before that, I would like to welcome the college chaplain, Father Ron Biganowski of the Society of Jesus, who will lead us in prayer. Following Father Ron's invocation, I invite you to enjoy lunch and conversation with those at your table. Father Biganowski.
This Business Leaders Forum meets to consider a perspective on monetary policy. Some monetary advice appears in Shakespeare's Hamlet when Polonius counsels his son, telling him, "Neither a borrower nor a lender be, for loan oft loses both itself and friend, and borrowing dulls the edge of husbandry." More gracious, generous advice comes from the Gospel of Luke, when Jesus encourages his disciples, "Give, and gifts will be given to you. A good measure, packed together, shaken down, overflowing, will be poured into your lap. For the measure with which you measure will in return be measured out to you." Balancing such options becomes a way of proceeding for Ignatius Loyola, founder of the Jesuits. At the opening of the spiritual exercises, he writes, "All the things in this world are gifts from God, presented to us so that we can know God more easily and make a return of love more readily. As a result, we appreciate and use all these gifts of God insofar as they help us to develop as loving persons." And so in gratitude for the good measure we are blessed with, for all God's gifts, let us bow our heads and pray. Good and loving God, we see your graciousness in our families, our friends, our richly blessed land, in our Marquette community. We thank you for the lasting care you show us. Grace us with the hope of your Son. Stir our hearts with your Spirit. Dedicate our gratitude to the work of your kingdom. Help us extend your peace and justice to the whole world. Finally, Heavenly God, we thank you for the food your bounty gives us. Grant that we may freely give to others what you have so generously given to us, and that we all may share in the banquet of heaven. We ask this through Christ our Lord, and let us all respond by saying, Amen.
Good afternoon. Sounds as though we've got some good table conversation going, but as you finish your meals, I think we'll get the program started. As I indicated earlier, my name is Dr. David Clark. I serve as the Executive Associate Dean for the College of Business Administration. I want to welcome everyone and thank you for joining us today. Before we get started, I want to point out a couple of things. First, you may have noticed there's a few students in the room, and some of them are going to need to leave the program before the program is concluded to attend afternoon classes. We actually encourage attendance in the classroom. So don't think they're being disrespectful. They're simply moving on to class. Second, if you haven't already done so, please silence those phones, students especially. And then finally, at the conclusion of Dr. Evans' presentation, there's going to be time for some Q&A. And if you do have a question, we have microphones that are set up around the ballroom. I think there are 3 of them. Please proceed to one of those microphones, and that will allow everyone to hear your question. So I'm actually standing in for our new Keys Dean of Business Administration, Dr. Brian Till. He had a previous engagement that he could not get out of, so he's very disappointed that he can't join us today, but he is looking forward to meeting many of you over the coming year. So just as a point of reference, this is actually the 16th Business Leaders Forum. And I want to extend Marquette's sincere gratitude to Frank and Kathleen Tometz and their son Michael for making this outstanding annual event something that can continue well into the future. So we thank them for that. I know we're all eager to hear from Dr. Evans, but let me take just a few moments to give you some college updates and preview an upcoming event. The biggest news, of course, is that we have a new dean, Dr. Brian Till. And he's only been here a few months, but he really has hit the ground running. He's been working with the faculty to complete a strategic plan that we've actually been working on for about a year now. So that really is coming to fruition. He set forth an aggressive agenda and an aggressive schedule to meet as many local business and community leaders as possible in his first year at Marquette. The college did get some great news over the last couple of weeks. When the U.S. News and World Report college ranking came out, they had the business school ranked in the top 100. They also recognized 3 of our specialty programs in their top 25. Our real estate program was ranked number 9. Our supply chain program was ranked number 14, and the finance program was actually ranked number 19. So we continue to do well in that survey. I'm also supposed to go 4 minutes here, so. In any case, I'm also excited to tell you about our annual Marburg lecture. It's hosted by the Economics Department. This lecture will be delivered by a renowned health economist, Dr. Emily Oster. She's been featured in the Super Freakonomics book that you might have heard about. She's also a TED Talk speaker. She's a brilliant young economist, and she's going to talk about her new thought-provoking book, Expecting Better. All right, and this actually uses data to help parents and policymakers make better pregnancy decisions. So the event is on October 27th. It will be held on campus, and there'll be more information listed on the Marquette website. So I hope many of you can join us for that. Lastly, I'd like to recognize several other people who are connected to the Chicago Federal Reserve Bank. Dr. Abdur Chowdhury, I think back there. He has been on the bank's Academic Advisory Council since 2010. Mr. William Foote is retired chair of the USG Corporation. He is here. He is currently chairman of the board of directors of the Chicago Federal Reserve Bank. And finally, Mr. Jeff Juris, executive chairman of the Manpower Group, is here, I believe. Jeff? He's a Marquette business alum and a university trustee emeritus. Mr. Juris is a past chairman and current member of the Federal Reserve Bank of Chicago's board of directors. He's also a past Business Leaders Forum speaker, so we're glad to have him here as well. So before I introduce our president, I also want to acknowledge our students, our faculty who are in the audience, alumni and friends from the business community who are here with us today. We want to thank you for everything you do for the Marquette College of Business. Now it's my great pleasure to introduce to you the 24th president of Marquette University, Dr. Michael Lovell.
Well, Dr. Clark, thank you. And 2015 represents Dr. Clark's 30th anniversary of being on the faculty here at Marquette, and we all want to thank you for your commitment to this university. This obviously is a signature event for our business school, and I want to thank all the faculty and staff for our college administration for really scheduling and making this event happen today. It's great to look out into the room and see so many leaders from across our region represented. And truly, we want to learn from our speaker today in ways that we can all change the world. And speaking of changing the world, yesterday, obviously, we said goodbye to Pope Francis as he returned back to the Vatican from the United States. And obviously, if you followed his journey and listened to his message, he challenged all of us that are in the mainstream to help those that are at the margins. And he served as a great example when he came to our country, and he went to a homeless shelter. He went to the prison to meet inmates, and went to schools educating children from migrant families, and showed how we all can make a difference in other people's lives that are less fortunate than ourselves. And as I look across the room and see so many leaders, from this region, and think of all the challenges that our region has, I just want to look forward to working with all of you to making Marquette a better community and finding unique ways to partner together so that we can help those less fortunate than ourselves. Now, it's my great pleasure today to introduce our keynote speaker, Charles Evans. And he's the President and Chief Executive Officer of the Federal Reserve Bank of Chicago. He served in that role since 2009, and he's been part of the Chicago Fed since 1991, when he joined it as an economist in the research department. He has been widely published in scholarly journals, and he advocates for new approaches to national monetary policy that often are contrary to conventional wisdom. I'm sure Dr. Evans feels right at home on our university campus. He taught at the University of Chicago and at the University of Michigan, and served on the faculty at the University of South Carolina. He and I were discussing at lunch today that we spent time together back in the mid-'80s when he was at Carnegie Mellon University and I was across the street at the University of Pittsburgh. So in some respects, we were neighbors. While Dr. Evans was earning his PhD at Carnegie Mellon, he did a lot of significant work that is published and is still very much cited today in his field. So will you please help me welcome the President and CEO of the Chicago Fed, Charles Evans.
Thank you. Thanks very much, President Lovell, for that kind introduction. Right, we were in Pittsburgh at the same time. I forgot to ask if you ever ate at the original hot dog stand that was affectionately referred to as the Dirty O back then. Thanks to the university and thanks to the Tometz family for supporting this wonderful event. Today, the Business Leaders Forum has been host to a very distinguished group of speakers, including Marquette alum and Manpower Group Executive Chair Jeff Juris, who was on my board, and it's also great to see Bill Foote here as well. Both have chaired my board, and that's a very important activity for us in Chicago. Our board of directors, we get a lot of great information ahead of FOMC meetings and also advice about how things are going at the bank, so it's really an honor to be here today. Now, before I begin, I should note that my commentary reflects my own views and does not necessarily represent those of my colleagues on the Federal Open Market Committee or within the Federal Reserve System. As I was looking through my prepared notes, I noticed that I used the term FOMC quite a lot, so I just want to mention that's this collection of policymakers, the Federal Open Market Committee, which is 12 Reserve Bank presidents and currently only 5 governors. At full strength, it's 7 governors. That's 17 people who get together in Washington at each meeting. That's a lot of talking. That's a lot for the chair, Janet Yellen, to listen to us all and then come to a very good, reasoned decision. She's a strong leader, and the comments that I make today often are in support of that type of activity, but we do have our own opinions. Now, although my comments today will be about the U.S. economy and current monetary policy challenges that the Federal Reserve faces, I know that this lecture series has been a forum for discussions about leadership. So I would like to motivate my comments today with an observation about how leadership challenges inform my policy analysis. In 2002, a psychologist by the name of Daniel Kahneman won the Nobel Prize in economics for his work related to the field of behavioral economics. He's the author of a recent book entitled Thinking, Fast and Slow. It's overly simplistic, but a simplistic synopsis of the book is this. Our minds are wired in complicated ways to solve a variety of problems. Sometimes our quick reaction brain reaches the right solution, and other times it doesn't. And that's when our slower, more thoughtful brain is required to get it right. Recently, I read an interview with Kahneman with the following subtitle: "What would I eliminate if I had a magic wand?" Overconfidence. This certainly is food for thought, particularly for leaders. Given my economics training, my 20 years experience attending FOMC meetings, and the outstanding analyses of my talented Fed staff, I often feel extremely confident about my monetary policy views. But policy mistakes can and have happened throughout the long history of central banks. With this in mind, I'm constantly asking myself, what if my policy proposals end up being wrong? So I try to have a plan B ready to go. For example, in 2011, in an effort to provide more monetary accommodation, I proposed that the FOMC adopt explicit forward guidance that linked our future policy actions to outcomes for unemployment and inflation. This guidance included a safeguard that said accommodation would be dialed back if it unintentionally kindled unacceptably high inflation. So the proposal had a plan B embedded in it. The Federal Open Market Committee adopted a policy along these lines in late 2012. As it turned out, we didn't need to invoke the safeguard, but I still think it played a critical plan B role in the policy's effectiveness. As my speech progresses, I hope you will see similar attempts to provide risk safeguards in my comments today. First, though, I'd like to begin with a discussion of the goals of monetary policy. Congress has charged the Federal Reserve with fostering financial conditions that achieve stable prices and maximum sustainable employment. These two goals, together known as our dual mandate, guide the Fed's monetary policy decisions. The FOMC has translated these broadly defined mandates into operational goals. For the first goal, the inflation rate over the longer run is primarily determined by monetary policy. So the FOMC has the ability to specify a longer run goal for inflation. Since January 2012, the committee has set an explicit 2% inflation target measured by the annual change in the price index for personal consumption expenditures. For the second goal, quantifying the maximum sustainable level of employment, that's a much more complex undertaking. Many non-monetary factors affect the structure and dynamics of the labor market, and these factors can vary over time and are hard to measure. Consequently, the committee does not set a fixed goal for employment, but instead considers a wide range of indicators to gauge maximum employment. Nonetheless, FOMC participants do provide their individual views of the longer-run normal level of unemployment that are consistent with the employment mandate. These can be found in the committee's summary of economic projections, which are published 4 times a year, and give participants forecasts of key economic metrics over the next 3 years and also for the longer run. In the most recent SEP, which was released a little over a week ago, the median participant estimated that the normal long-run unemployment rate was 4.9%, and my own assessment is in line with this projection. Given these operational objectives, how close are we to achieving the dual mandate? There's no doubt that labor markets have improved significantly over the past 7 years. Job growth has been quite solid for some time now, and the unemployment rate has declined significantly from its peak of 10% in 2009, and currently stands at 5.1%. This is just 0.2 of a percentage point above the median long-run projection. However, a number of other labor market indicators lead me to believe that there still remains some additional resource slack. Notably, a large number of people who are employed part-time would prefer a full-time job. The labor force participation rate is quite low, even after accounting for demographic and other long-running trends, and wage growth has been quite subdued. My colleagues on the Federal Open Market Committee and I project that over the next 3 years, the unemployment rate will edge down further and run slightly below its long-run sustainable level. I also believe the elements of extra labor market slack I just mentioned will dissipate over that time. So what's driving this forecast? Well, gross domestic product growth appears to be well positioned to continue at a fairly solid, though not spectacular pace for some time. In particular, consumer spending looks to be advancing at a healthy rate, supported importantly by the improvements in the job market. We economists sometimes refer to this as the virtuous cyclical dynamic. More jobs lead to more spending, which in turn leads to more jobs. So although there are some risks, I'm relatively confident that we will reach our employment goal within a reasonable period of time. However, I am far less confident that reaching our inflation goal within a reasonable time frame. I'm far less confident about reaching our inflation goal within a reasonable time frame. Inflation has been too low for too long. Core PCE inflation, which strips out the volatile energy and food components and is a good indicator of underlying inflation trends, has averaged just 1.4% over the past 7 years. This morning, we received another reading. Core PCE inflation over the past 12 months has been just 1.3%, and the total price index has barely budged, rising just 0.3% over the past year. Most FOMC participants expect inflation to rise steadily from these low levels, coming in just a shade under the committee's 2% target by the end of 2017. My own forecast is less sanguine. I expect core PCE inflation to undershoot 2% by a greater margin over the next 2 years than do my colleagues. I expect core PCE inflation will be just below 2% at the end of 2018. A number of factors inform my inflation forecast. First, low energy prices and the relatively strong dollar continue to generate downward pressure on consumer prices, but these influences are expected to be temporary. Second, putting aside the swings in energy prices and the like, core inflation tends to change quite slowly, particularly when it is at low levels. So low core inflation today tends to be a harbinger of low overall inflation for some time. Third, wage growth has been very subdued, coming in around 2 to 2.5% for the past 6 years. This is well below the 3 to 3.5% pace we would expect in an economy growing at its potential and with inflation at 2%. Although higher wage growth is not necessarily a strong predictor of inflation, it is a good corroborating indicator of underlying inflation trends. So given these forces holding back inflation, why do I expect it to increase? Additional improvements in the labor market should help boost inflation. Another important determinant of actual inflation is the public's perception of inflationary trends, because these views get built into the pricing decisions of businesses and the wage aspirations of workers. Currently, these expectations appear to be higher than actual inflation, so they should help boost inflation once temporary influences dissipate. Furthermore, economic theory tells us that in the long run, inflation is a monetary phenomenon, and my forecast for a gradual rise in inflation critically depends on monetary policy maintaining a highly accommodative stance for some time. Now, I began by noting that effective leaders must use their expertise and good judgment to chart a course for the future, but that they must also guard against overconfidence and have a good plan B in hand in case obstacles materialize. In determining the best course for monetary policy, I believe the Fed should follow this principle. How does that apply to today's situation? Currently, there are some downside risks to reaching our maximum employment goal, namely the potential for weak foreign activity to weigh on U.S. growth. But as I noted earlier, we've made tremendous progress towards this goal. Economic growth appears to have enough momentum that I'm fairly confident that we will reach our maximum employment goal within a reasonable time. However, to reiterate, I am far less confident that we can reach our 2% inflation target over the medium term because of a number of important downside risks to the inflation outlook. Reading this medium term, I am reminded that this is a somewhat elastic term. Sometimes when you use it, it sort of means 2 to 3 years. Other times it kind of means 3 to 4 years. It's much more a term of art than science. Having said that, with prospects of slower growth in China and other emerging market economies, low energy and import prices could exert downward pressure on inflation longer than I anticipate. That's a risk. In addition, while many survey-based measures of long-term inflation expectations have been relatively stable in recent years, we shouldn't take them as confirmation that our 2% target is assured. In fact, some survey measures of inflation expectations have ticked down in the past year and a half. Furthermore, financial market-based measures of inflation compensation have moved quite low in recent months. These could reflect either lower expectations of inflation or a heightened concern for the economic conditions that are associated with low inflation. Adding to my unease is anecdotal evidence. I talked to a wide range of business contacts, and none of them are mentioning rising inflationary or cost pressures. None of them are planning for higher inflation. They don't expect it. How does this asymmetric assessment of risk to achieving the dual mandate goals influence my view of the most appropriate path for monetary policy over the next 3 years? It tells me to conclude that a later liftoff and a gradual normalization of our monetary policy settings will best position the economy for potential challenges ahead. Before raising rates, I would like to have more confidence than I do today that inflation is indeed beginning to head higher. Given the current low level of core inflation, some evidence of true upward momentum in actual inflation is critical to this assessment. I believe that it could be well into the middle of next year before the headwinds from lower energy prices and the stronger dollar dissipate enough so that we begin to see some sustained upward movement in core inflation. After liftoff, I think it would be appropriate to raise the target interest rate very gradually. This would give us sufficient time to assess how the economy is adjusting to higher rates and the progress we are making toward our policy goals. Overall, my view of appropriate policy is somewhat more accommodative than what is represented by the median of the Federal Open Market Committee's well-known dot chart. This is the chart that shows FOMC participants' views of the appropriate target federal funds rate by the end of each year for 2015 through 2018, and also our view of longer-run normal interest rates. Most of my colleagues think that it will be appropriate to raise the target federal funds rate sometime this year. These prognostications envision a slow increase over the next 3 years to about 3.5% for the funds rate at the end of 2018. On average, this path is consistent with the target federal funds rate increasing by 25 basis points, a quarter of a point, at every other FOMC meeting over the next 3 years. This is certainly a gradual path by historical standards. It is even slower than the so-called measured pace of increases over the 2004-2006 tightening cycle, which was 25 basis points per meeting. And in fact, some economists have criticized that path as being much too slow. So the median of the dot chart forecast for the funds rate is much more gradual than that. As I said, I think policy should be somewhat more accommodative than this course of action suggested by the median forecast of the latest SEP. In my view, an additionally patient approach is warranted for several reasons. And I hope you see my logic reflects my risk management approach to monetary policy. First, after several years of below target inflation performance, and in light of the downside risk to the inflation outlook, appropriate policy should provide enough accommodation to generate a reasonable likelihood that inflation in the future would moderately exceed 2%. Aggressive pursuit of achieving our 2% target sooner rather than later does indeed open the possibility of modestly overshooting 2%. But this is not as heretical as it might first appear. After all, this is a consequence of having a symmetric inflation target. It is difficult, it's not possible, to average 2% inflation over the medium term if the track record and near-term projections of inflation are all less than 2%. You can't average 2% if you're always below it. Furthermore, maintaining credibility is key to effective policy. Policy needs to validate our claim that we aim to achieve our 2% inflation target in a symmetric fashion. Failure to defend our inflation goal from when we are below target may weaken the credibility of this claim. The public could begin to mistakenly believe that 2% inflation is a ceiling and not a symmetric target. As a result, expectations for average inflation could fall, lessening the upward pull on actual inflation in all of our forecasts and making it even more difficult for us to achieve our 2% target. Second, consider the other policy mistakes we could make. One possibility is that we begin to raise rates only to learn that we have misjudged the strength of the economy or the upward tilt in inflation. In order to put the economy back on track, we would have to cut interest rates back to zero and possibly even resort to unconventional policy tools, such as more quantitative easing. I think quantitative easing has been effective, but it clearly is a second-best alternative to traditional policy, which simply amounts to interest rate cutting. This scenario is not merely hypothetical. Just consider the recent challenges experienced in Europe and Japan. Policymakers in those countries tried to raise rates from their lower bounds, but faced with faltering demand, they were forced to reverse course and deploy non-traditional tools more aggressively than they had before. And we all know the subsequent difficulties Europe and Japan have had in rekindling growth and inflation. So I see substantial cost to premature policy normalization. Now, an alternative potential policy mistake is that sometime during the gradual policy normalization process, inflation begins to rise too quickly. Well, we have the experience and the appropriate tools to deal with such an outcome. Given how slowly underlying inflation would likely move up from the current low levels, we probably could keep inflation in check with only moderate increases in interest rates relative to current forecasts. And given how gradual the projected rate increases are in the latest SEP, the concerns being voiced about the risks of rapid increases in policy rates if inflation were to pick up seem overblown. We have the capacity to raise rates. We've done it in the past. If we have to, we'll do it. That's a tool that we have in our toolbox readily. Furthermore, as I just outlined, there's no problem in moderately overshooting 2%. After several years of inflation being too low, a modest overshoot simply would be a natural manifestation of the Federal Reserve's symmetric inflation target. Moreover, such an outcome is not likely to raise the public's long-term inflation expectations either. Just look at how little these expectations appear to have moved with persistently low inflation readings over the past several years. So I see the cost of dealing with the emergence of unexpected inflation pressures as being manageable. All told, I think the best policy is to take a very gradual approach to normalization. This would balance both the various risks to my projections for the economy's most likely path and the costs that would be involved in mitigating those risks. Now, in my remarks today, I've stressed the need for the Federal Open Market Committee to follow interest rate policies that credibly demonstrate its commitment to a symmetric inflation target. As I noted earlier, one of the channels through which monetary policy affects the economy is through its influence on the public's expectations about inflation and economic activity. Accordingly, a critical component of monetary policy is to effectively communicate how we aim to achieve our long-run goals and strategies. Policymakers must clearly describe how their views on the appropriate path for monetary policy will help generate outcomes for employment and inflation that are consistent with achieving the mandated goals within a reasonable time frame. Moreover, they must demonstrate they have appropriately considered the risks to their outlooks on the economy. I hope I've done that for you today by laying out my forecast for the economy and what I consider to be the appropriate path for policy. Now, we also need to be clear about how monetary policymakers will react to new data as the economy evolves. We talk a lot about data dependence, but what does that really mean? To me, it involves the following: evaluating how the new information alters the outlook and the assessment of risks around that outlook, and adjusting my expected path for policy in a way that keeps us on course to achieve our dual mandate objectives in a timely manner. So if in the coming months inflation rises more quickly than I currently anticipate and appears to be headed to undesirably high levels, then I would argue to tighten financial conditions sooner and more aggressively than I presently do. If instead inflation headwinds persist, I would advocate a more gradual approach to normalization than I currently envision. In either case, my policy forecasts would change, and I would explain how and why they did. Such communication helps clarify our reaction to new information, the so-called Fed reaction function you hear financial market analysts talk about. This in turn makes it easier for households and businesses to plan for the future. Such transparency is a key feature of goal-oriented, accountable monetary policy. Thanks for your attention, and I look forward to your questions.
Thank you, Dr. Evans. So we have microphones set up at 3 different locations. So if you have a question that you would like to pose to Dr. Evans, please make your way to one of those microphones so that everyone can hear the question, and Dr. Evans obviously can hear the question as well. So,
Dr. Evans, if monetary policy is defined as 1 being accommodative and 10 being tight, where do you think we are now? And if Plan B, I'm interested in Plan B, if you're wrong and the economy actually rolls over, what policy tools are available to you given where we are today?
I'm sorry, could you repeat the last part? I was thinking about the first part.
You talk about always having a Plan B.
Yes.
And your Plan A is that the economy is going to continue to expand for some time period here. If Plan A is, if you're incorrect, as many of us who have to forecast often are,
Right.
if you're incorrect and actually we enter a recessionary time period earlier than your expectations set,
Gotcha.
what monetary policy options do you have given where you're at today?
Right. Right. Thanks. Well, I think that if we find ourselves facing a bad outcome, if things were to weaken very much, then we'd probably need more accommodation. Now, there are other things that could happen, actually. I mean, this all depends on the entire landscape of things. First part of your question was, are we accommodative or are we tight? 1 being accommodative, 10 being tight. It's really hard to know the answer to that. On the one hand, you'd kind of go, well, we must be about a -5 because the funds rate's been at 0 for as long as it has. So clearly, it's almost like an IQ test that it's got to be that it's very accommodative. But in fact, the entire world has been experiencing slower growth than we would expect. There's good reason to believe that that leads to lower real interest rates, apart from inflation, that when the world economy is not growing very strongly, when there's not a lot of pressure on resources, when there's an abundance of savings relative to those funds being used, that interest rates end up in equilibrium being much lower. And if you took that very seriously, you might come to the conclusion that we're about a 5 in terms of accommodation, that we're just barely accommodative, maybe even neutral on that. I think that's a little too harsh. I think it's, it's accommodative, but those are some of the things that we have to wrestle with in terms of the global economy and the U.S. economy and where we are. Now, if we got ourselves into a situation where activity wasn't growing as much as it should, there are some other things that could happen. For one thing, Congress and the President could all of a sudden decide that maybe it's time to pass a highway bill or to increase fiscal stimulus, and that would support more demand and get the economy going. One of the reasons why we have had to pursue these unconventional, highly accommodative policies as best we can through asset purchasing is because there's been no other source of stimulus coming from other actors. And so if that situation changed, then it could be that we would need to actually raise rates and the economy wouldn't suffer through that type of slowdown. So it's not obvious that we would have to do a lot more, but if we were left with the same type of fiscal restraint that we've been facing and the real economy wasn't doing better and we couldn't lower rates, then you would think that we'd have to do more asset purchases. I'm very optimistic about the economy. I think that we're growing as well as we can at the moment. I mean, I've got a forecast for about 2.5% growth over the next couple of years, the unemployment rate continuing to improve, and I'm very hopeful that the global economy, that the foreign central banks are setting accommodative policies there in order to get their economies going and inflation going. So I think that we're in a much better place, but we need to consider those plan Bs.
Next question over on the right.
You kept referring to a desired rate of inflation of 2%. Where did that goal come from, and how long has that been the goal?
That's a great question. So that has been our explicit goal going back to January 2012. The Federal Reserve Act simply says we should pursue monetary and financial conditions to support maximum employment and price stability. Now, you might think of price stability as zero inflation, and if you had a gold standard, maybe that would be the case. But one of the problems with very, very low rates of inflation, Milton Friedman, optimal inflation probably comes in at about -2% is optimal, but most countries that have experienced negative inflation have had really bad economic outcomes. The rationale for something along the lines of 2 is that when you've got 2% inflation and real rates are 2%, 1.5%, the nominal rates are going to be high enough so that if the economy begins to falter a bit, you can cut rates. You've got enough headroom to cut rates so that you don't hit zero. This is the problem. When you hit zero and you need to do more, you don't have the capacity unless you try something else out. So 2% was viewed as sufficiently high, still associated with price stability, in line with our mandate. And I think it actually presents challenges for us because we've now hit the zero lower bound arguably twice in the last 10 years, 15 years, and our economic models told us that that really shouldn't happen more than 1 out of 10 times during economic cycles. So there's something that we don't really understand very well. But that's why I keep saying we need to be very aggressive in our commitment to a symmetric inflation objective, because if you're in fact implementing something that's less than 2%, you've got less headroom in order to deal with that.
Yes.
Yes. I actually have 3 questions I'd love to ask, including what you think about the influence of high-speed trading on the treasuries. But I will also like to ask the question about what Bernanke put in place with the twist and basically undoing the twist and how that basically influences your thought processes.
So the twist, let me describe it this way. When after Lehman Brothers, when the Great Recession was in full throttle, as everybody was trying to provide support to find a bottom for the economy. The Fed cut rates all the way to zero by December of 2008, and it wasn't clear yet that we were bottoming out, so more accommodation was necessary. So in March of 2009, the Federal Reserve announced unconventional policies. We had a variety of liquidity programs that we introduced, but we also announced that we were going to purchase $1.75 trillion of mortgage-backed securities and $200 billion of agency debt and $300 billion of treasuries. So that's an awful lot, a very large amount of credit easing, as Chairman Bernanke preferred that to be referred to. Everybody else calls it quantitative easing. That was QE1. By the fall of 2010, it became clear that disinflationary pressures were too strong and we needed additional asset purchasing, and so we embarked on $600 billion of asset purchases in 2010. By the summer of 2011, when it became evident that we needed still additional accommodation to get inflation up, it also was apparent that additional asset purchases were somewhat unpopular, and we searched for something that could provide also credit easing without outright asset purchasing. That's when we came to do what you refer to as Operation Twist, and instead we decided to sell our short duration assets in favor of long duration assets. It had the same effect of reducing long-term yields, and that was beneficial for the economy, but not enough, because by the time we got to 2012 and still underrunning our inflation objective and the economy not doing as well as it should with unemployment at 8%, we embarked on QE3, open-ended asset purchases. Unwinding the twist is being unwound as we speak, just because the maturities of our balance sheet are what used to be all long duration. 2011 was 4 years ago, so things that were previously long-term assets have now matured into the medium and shorter term assets. It's sort of taken care of itself, and now most of this comes down to, as we raise rates, when will we stop reimbursing the maturing proceeds, and how will we allow the balance sheet to unwind? Those are still issues to be discussed.
Thank you. One comment and a question. The sensibility situation. Chairman Yellen, for many quarters, has been leading America on the tack that we were getting closer and closer to a rate shift. The sensitivity within the Federal Reserve seems to have gotten lost in terms of tracking the stock market. The stock market was very sensitive to what was coming out of the Fed for several quarters. But the stock market was prepared in September to hear the Federal Reserve raise the rate. Subsequent to not doing it, we now have to go through the same rigors of the stock market adjusting, which we see in the last several days now, that it's underway, and with the disappointment. And we have to go through this whole procedure again, listening to the Federal Reserve about when it's going to be ready to spring forward and do a rate increase. So I think that this situation here has gotten out of control, at least over the last 3 months and maybe more. You can comment on that. And then secondly, I would like to say this. 50% of all S&P 500 companies' revenue stream comes from international. The strength of the dollar is circumventing American companies to keep on track internationally. If you're looking for inflation as a vehicle to get you to convince yourself that it's time to raise the rate, then we need to raise the level of business in the international market, and therefore somehow we got to short circuit the growth rate in the price in the dollar relative to other currencies, because you can read report after report of S&P 500 companies, and the negative number in their quarterly statements is not good. Thank you.
Thanks. Yeah, that's a lot to digest. One thing that we've sort of lost sight of since 2008 is, we've had this period where the funds rate's been at zero. We've had this long period of time where we've talked about how, the funds rate was going to be zero for an extended period of time. And we haven't had a lot of disagreements or the expectation that we were going to start changing the funds rate. We've had, we focus on, are you going to do asset purchases? You're going to stop asset purchases and things. So we've still had markets and the public trying to make inferences about changes in monetary policy. There's no doubt about it. But what we're getting back to is sort of circumstances like we used to have during other difficult times when the funds rate was at 4% or 5%, when the Fed is sort of looking at a period where they need to raise rates. In 1994, the funds rate had been at 3% for 18 months, and the Fed announced that they were going to embark on readjusting the funds rate. And, it has big effects on markets because they don't know exactly the timing and do they know what the path is going to be. I would say that we've spent a lot of time thinking about our communications. We now have our summary of economic projections. You can look there and see what the FOMC's expectations are for the likely path of increases in the funds rate. What you will find is a lot of dispersion in the opinion among participants, but still you'll see as much information as any possible person committee could provide. And then markets just have to assess that. That's what markets do. They do it well, and I understand why everybody pays attention to the stock market and their valuations, perhaps on a daily basis, maybe an hourly basis. But as I read the financial planning advice, it's a good idea to sort of set your valuation allocations, let them go, don't get involved in too much, tinkering with that and whatnot. So, it's not our job to pay an extraordinary amount of attention to what the stock market is on any particular day. We're trying to find out what the fundamentals of the economy are, what best supports job creation, wealth creation, income creation for everybody in the U.S., and stand back out of the way as best we can. But we are at the point where we're closer to normalization, and we need to be communicating and taking stock of that. In September, events got in the way. China was experiencing more difficulties than we were expecting. The global economy continues to have uncertainties. And the basic message was, we're just going to stop, assess this a little bit more, and feel more comfortable when we lift off. And we're going to go into our next meeting and thereafter to argue over that. But you did touch on another issue, which is sort of a very difficult and somewhat conflicting issue, which is that the strength of the dollar is having challenges for U.S. companies working abroad, affecting their bottom lines. And, I can tell you that the theory, I can't tell you how it'll work out because the empirics don't match the theory all the time, but the theory is once we start raising rates and people believe that the U.S. is an even stronger economy because we can survive that, the value of the dollar is likely to go up. And that's going to challenge our exports abroad and companies whose business is tilted in that direction. So when are we going to lift off? We're going to figure that one out. Once we do, though, it's going to have that dollar challenge. So balancing those and understanding it, making sure that the economy's strong enough for that, I think we just have to sort through that.
Yes, sir.
My question is a little bit unique. I look at the sign over there, it says excellence, faith, leadership, and service. And you're certainly leading our country in monetary policy. As a Christian, here in a Christian organization, it's interesting. The Bible talks a lot about the future and prophecy. And in Joseph in Egypt, there was the first one world monetary collapse that took place, probably in the second year of his tenure of the 7 years of the crisis. And we have today all the world reserve currencies all seem to be spiraling down over time. The dollar seems to retain and strengthen because we're the world reserve currency that everything trades in. We periodically stimulate our economy through debasing the dollar a bit and buying global GDP. John Maynard Keynes had a Plan B that he invented in 1944. It was called the SDR, a global basket of currencies made of dollars, euros, pound, yen, which is today, as you know, the basket that the IMF uses. As a Christian financial advisor, I've been monitoring the IMF documents. And I have 8 documents here from the IMF that lay out a blueprint for the transformation of the world monetary system. And it's a little disheartening when I think as an American wanting to protect the dollar, wanting to protect our country's financial engine, seeing economic warfare take place. We had an attack on the dollar on September 11th, 2001. We had an attack on the dollar September 23rd of 2008, both on Shemitah years. And in 2008, there was as you know, a naked short selling on bank stocks. It was economic warfare attacking the dollar. And now it's actually today is the end of a Shemitah, a Sabbath year again. And we have some important decisions being made in Washington today that, as a Christian, I think God might judge our country. How do you lead going forward as a in the Federal Reserve, protect the dollar as the world reserve currency, navigate against the kind of terrorism and attacks that can come at us that could cause us to have to print money in insane amounts like we did in 2008 to stabilize the system? How do you lead going forward as a member of the Federal Reserve?
Well, I think that, when we stay true to our stated strategy, which is consistent with the Federal Reserve Act, the mandate that Congress and the President gave us long ago, but have updated as recently as the Dodd-Frank legislation, that provides us with the best footing for keeping the economy on a strong fundamental footing so that it can withstand any types of attack along the lines of what you're talking about, and promote job creation, income safety, income creation, wealth creation. So I think it ends up benefiting everyone. When we have inflation at our objective, when we are providing monetary policy to support maximum employment, when everything else is also not at odds with those same goals, at a minimum, even better if they're fully aligned and supportive, then it's even better, then I think we're in good shape. If we could get the funds rate up to a more normal level, like the ones we talk about in our summary of economic projections, we would be best positioned to then deal with any events, shocks that come our way. We'd have the capacity to ease, or we'd have the capacity to tighten. At the moment, we have mainly the capacity to tighten. We can do that very easily, and markets are concerned about that, so it's even more powerful, if you will, for being restraining function. But to ease is more difficult, so we need to, I would say we'd be well served to make sure, just carefully assess that the fundamentals are as good as they can be before we start tightening. But all of those things are meant to support the objective that I think you're laying out there.
I think we have time for a couple more quick questions, if we could.
They require quick answers, too. I'll try to do my part.
The lightning round.
Thank you for coming. So in January of this year, Chairwoman Janet Yellen addressed her concerns about rising income inequality in the United States. She cited a historical trend of stagnant or stable wages. I was wondering how slow growth in wages influences your ability to make forecasting and how you factor that in.
Yeah, that's a good question. I think what Chair Yellen did was to cite the best economic research that we have available on the subject of income. How is it proceeding across different income lines, what people have called inequality. Macroeconomic policy works from a very simple presumption, which is if I get the economy going, everybody will share in the benefits of that. And as long as there's sufficient sharing across those different levels and economic players, business, capitalists, labor, everybody involved, households, then I think that works. To the extent that you're concerned that it's not shared in sufficient proportion, you need to be concerned. What I took her speech to be was to lay out what some very smart economists have said the facts are likely to be. So I think that's important, and we need to stop and make sure of that, because I think we need for wages to start increasing to help support better consumption, stronger households. Better business spending comes from that.
Looks like we have 2 more people at the microphones. I think we can accommodate both of those, and then we'll wrap things up. Yes, sir.
The gross domestic product kind of being the gross number both for goods and services. And I think in terms of technology where, whether it be computers, televisions, diagnostic equipment, or services like, Uber is taking the cost out of many things. What's your thoughts on the GDP being a gross number? That is it really a good indicator of really the gross, gross revenue of this country, when I think a lot of more profitable type companies are more profitable with lesser, offering products and services actually at lesser prices, like LED lighting and things like that. What's your thoughts on that number being a good measurement? Is to a barometer to the economy when maybe we're doing better than we think, but prices are just less costly in a good way?
I think that the national income accounting procedures that give rise to the gross domestic product data are fundamentally sound and will pick up on new activities like Uber and things like that. Undoubtedly, there are challenges in measuring. It's sort of ironic that the best economic data that we ever measure come from government-regulated entities. If the government's involved in regulating something, we measure it very well. But if it's outside of that, you don't really get to see it. It's ironic. It just happens to be, the case. So, Uber and others, as they're sort of outside of that, the measurements are a little trickier perhaps, but I'm pretty confident that they're smart people at the Bureau of Economic Analysis and also the Department of Labor, and they can figure that out. But the real point here is that business models are changing. New technologies are coming about. The mobile technology is allowing new competitors to show up in places where there wasn't competition, or there wasn't competition like that, the digital environment. And that's just challenging a lot of existing capital, business entrepreneurship, and people are responding. And they're responding to incentives. And, when there's a lot at stake, that brings a lot of resources together. I think ultimately we end up in a better place, but it can be exceedingly difficult. And people who have made good livelihoods with some activities now are challenged, and we need to have a sufficient fluid and flexible workforce and economy so that we can adapt as best we can, because those challenges aren't going to go away, no matter how you might wish them to.
And one last question.
Thank you for answering our questions so far. My question was that with the recent volatility in the stock market that we saw with the Chinese currency devaluation and the recent slowdown in the emerging markets, what do you think are the biggest challenges that our economy will be facing in the next few years, and how do you plan to deal with that?
Well, I think the global environment continues to be a challenging one. I think that China's a very important economic player over the future. If you think about you ever thought about what the history of the world would be after World War II if China had not been a communist country but had somehow unleashed a private market mechanism from the outset, and we had competed against that in that hypothetical? Who knows how everything would have come out. We have more economies, more people coming into global marketplaces and benefiting from that, increasing their nutritional standards by small dollar measures, but having huge, wonderful effects on welfare broadly measured. But it's more competitive, and I think those are the issues that we're going to have to be dealing with: global competition, best positioning our own economy and workforce and businesses to compete, not to stick our heads in the sand, not to hope that the old jobs that were very good paying, middle class jobs that you might be able to get without a college education. We need alternatives. We need to make sure that people are fully invested in making good decisions to improve their lives and compete at that global level, because you just can't wave a magic wand and make that go away.
Well, thank you very much. Thank you, Dr. Evans, for a great talk. So this concludes the program for today. Thank you all for attending. We look forward to seeing you at future Business Leaders Forum. Thank you.